Welcome to Earnings Roundup. We are looking at Gap Inc.'s Q3 2025 results.
And they absolutely crushed expectations this quarter. Earnings per share came in at 62 cents.
Right, versus the 58-cent forecast.
And revenue of $3.94 billion, just edging out the forecast there too.
And that strong performance, of course, meant they immediately raised their outlook for the year.
Full-year net sales guidance is now pushed to the high end of that 1.7 to 2% growth range.
And the operating margin, which is so critical, is raised to about 7.2%.
Yeah, a confident update.
So when you look at the headlines, the number that just screams confidence is that comparable sales growth.
Oh, yeah.
Up 5%. I mean, for a retailer of this size, that is a staggering result.
It's their highest quarterly comp growth in over 4 years.
And the 7th straight quarter of positive comps for the whole portfolio.
That 5% comp growth is really the engine here. It's what let net sales climb 3% year over year to that $3.94 billion number.
But, and this is a big but, you have to understand that while the top line is roaring, the bottom line is, well, it's still feeling some serious pressure.
Exactly. Net income actually declined 14% to $236 million.
And we know the primary culprit there, which we should just get out of the way up front, tariffs.
Tariffs. It was a massive headwind just eating directly into profitability this quarter.
Right. And that complexity, great sales, but these external pressures, it made the market reaction pretty interesting.
It really did. The stock saw a little bump in after-hours trading, even though the regular session was flat. Investors are signaling that the underlying business, that 5% comp, is strong enough to outweigh the short-term hit.
The CEO, Richard Dickson, he framed this as performing while we transform.
Which can sound like marketing speak, but the cash position really backs it up.
Yeah, they ended the quarter with $2.5 billion in cash, up 13%. That gives them a real runway to execute without, panicking.
Precisely. They are funding these strategic moves internally. And that 5% growth is really a story about brand-by-brand success.
So 3 of the 4 core brands did really well.
Yep, they posted strong, positive comps. It shows the playbook is actually working across most of the portfolio.
Okay, so let's start with the undisputed powerhouse, Old Navy. Comps were up a very strong 6%.
And Old Navy has just been consistently gaining market share over the last couple of years.
Especially in those categories that are driving all the traffic right now, right?
Yeah.
Active, denim, and kids and baby.
The active category is the critical piece here. It delivered double-digit growth.
Wow.
Making Old Navy the #5 active apparel brand in the U.S., that's a massive validation that their push is working.
But what's really fascinating with Old Navy is how they're looking for totally new growth areas.
Yeah, beyond just the core apparel.
Right. They've used collaborations, like the one with Anna Sue, to inject this sense of high fashion into their regular lineup. It just builds excitement.
And that strategic push is most obvious with the pilot launch of their beauty category.
In 150 stores.
This isn't just about selling lipstick. It's about higher margins, getting customers in the door more often. And, well, it's a very calculated move to diversify.
Okay, so as Old Navy is a powerhouse, then the namesake Gap brand is the viral accelerator.
For sure. Comp sales were up 7%, just a phenomenal figure.
And their 8th consecutive quarter of positive comps. The story here is just as much about cultural resonance as it is about product.
It absolutely is. And the clear catalyst was that Better in Denim campaign with the global music group Cat's Eye.
The numbers on that were just insane.
I mean, over 8 billion impressions and 500 million views. It was a genuine social media phenomenon.
But it's one thing to generate impressions. The question is, did it actually translate into sales? Huge digital reach doesn't always pay the bills.
It did, spectacularly. It really achieved 2 crucial goals at once.
Which were?
First, it attracted a younger, that elusive Gen Z consumer right into the denim category. And second, it reinforced loyalty with their core customer.
And the proof is in the ranking.
Exactly. Gap is now the #6 adult denim brand in the U.S., up from #8 last year. They are actively stealing market share.
And they seem to have cracked the code on those high-low partnerships, too. That Sandy Liang collaboration was huge.
It was, and it brought in over 25% new customers.
Yeah.
But what's even better for the company long-term
What's that?
is that 20% of those shoppers bought products beyond the collaboration.
That's the holy grail, right?
Yeah.
You use the hype to get them in the door, and the core product keeps them shopping.
That is a repeatable formula. It's a huge win.
Okay, so moving down the portfolio, Banana Republic is finally showing consistent life.
Yeah, comp sales were up 4%. That's their second solid quarter in a row after years of, well, volatility.
And the success there seems less about big campaigns and more about just internal execution, getting the product right.
Exactly. They're making real progress harmonizing the men's and women's lines. We're seeing strength in women's dresses and wovens because of better fit and, just better quality.
So if the top line is thriving, let's pivot to the headwinds, because they are significant.
Absolutely. The overall gross margin declined a bit to 42.4%. And as we mentioned, tariffs were the big story.
Yeah.
Tariffs created an estimated 190 basis point headwind on merchandise margin.
Wow, that is a staggering amount of external drag. But wait, if they only lost 30 basis points overall, and they had a 190 basis point headwind from tariffs, that implies an incredibly strong underlying performance.
That's a great question, and the data backs it up. They achieved roughly 120 basis points of underlying margin expansion.
Okay, so for our listeners who don't live and breathe retail finance, what does that really mean in practice? High AUR growth.
It means they're demonstrating pricing power. High AUR or average unit retail, it just signals that consumers are paying more for each item.
Because they're not discounting as much.
Exactly. The product is resonating so well, they don't need to put it on sale. So yeah, if you took away that tariff headwind, their margin would have jumped significantly. That 120 basis point gain is the core sustainable improvement.
And that's key, especially with all the macro uncertainty out there. They're winning with all income levels.
It is, but we can't ignore the one major drag on the entire portfolio.
Athleta.
Comp sales were down 11%. Net sales also dropped 11%. It's basically canceling out some of the great work from the other brands.
The CEO called this a reset year for Athleta. That sounds like corporate shorthand for a deep, deep crisis.
It's shorthand for this is going to take time. The focus is on repositioning it as a premium, aspirational brand again. The problem is the brand just lost its identity.
They tried to scale too fast.
Way too fast, and the product got muddied. So the new brand president is reorganizing talent and, crucially, editing the assortment.
Which is a high-risk move. How do you do that without alienating the loyal customers you still have?
It's a tightrope walk, but they need to clearly define what premium means in today's crowded activewear market. Management was very clear. This will take time. We should expect softness for a few more quarters.
Okay, so let's look forward then. They raised their full-year guidance. What gives them that confidence, especially with tariffs?
The confidence is built entirely on their 2026 mitigation strategy, and they use this key phrase, the annualization of tariffs.
Okay, can you break that down? What does that mean for the average person listening?
Sure. It just means that starting next year, they'll be comparing their current tariff costs to the same high tariff costs they face this year. So the rate of change goes away.
Oh, so the shock of the increase is gone. It just becomes the new baseline.
Exactly. The negative impact stops growing, and they're working to lower that baseline by making adjustments to sourcing and manufacturing.
So rejiggering their entire global supply chain.
That's a big part of it. And the rest will be very targeted pricing adjustments. They're being extremely careful not to raise prices so much that it hurts sales.
And the timing on that. When do the benefits actually kick in?
So Q1 2026 will still be rough. But they expect to see meaningful benefits starting in Q2, creating a pretty big tailwind in the back half of the year.
Let's touch on operational efficiency too. They're talking about $150 million in cost savings.
Right, but they also said they're reinvesting a portion of that.
So is this a real gain for shareholders, or are they just running in place against inflation?
It's a bit of both, but I'd frame it positively. They're showing the discipline to create the savings, but the strategic aggression to immediately deploy it into growth areas, like beauty. They're prioritizing future growth.
And finally, their physical stores.
Yeah.
Still closing some locations.
Yeah, about 35 net closures expected, mostly at Banana Republic. It's all part of that optimization strategy. Fewer but better stores.
So let's bring this all together.
Yeah.
Gap Inc. has pretty demonstrably proven that its strategic playbook is working.
Mm-hmm. They're successfully translating that cultural relevance, the viral campaign, the collabs, into real sales growth at Old Navy, Gap, and now Banana Republic.
The underlying business is fundamentally strong.
Huh.
You can see it in that underlying margin expansion and the AUR growth.
Yeah.
The product is winning.
Yeah.
But the complexity of the tariffs and that long, slow reset required for Athleta remain the big variables. They determine how smoothly this all continues.
Which really raises an important question for you to mull over as you watch this story unfold. Gap is increasing its capital expenditures to about 550 million for the fiscal year.
Right, even while they're closing stores.
Exactly. So with that level of investment, how quickly will their big bets, the new store formats, the beauty expansion, the Athleta turnaround, how quickly will those need to deliver returns to justify the immense financial confidence they just showed us this quarter? It's really a race between their execution and those external pressures.